One number defines this crisis better than any headline: $423,736 per day. That is the verified benchmark freight rate for a single, very large crude carrier attempting to move oil from the Middle East to China as of March 3, 2026. Confirmed by LSEG data, an increase of more than 94% from the prior Friday's close, an all-time record in the history of global shipping. That number is not a prediction. It is not a projection. It is what the market priced when it concluded that one of the world's most critical maritime choke points had effectively ceased to function. The Strait of Hormuz, a corridor 21 nautical miles wide at its narrowest point, through which approximately 20% of the world's daily oil supply flows, is, as of this briefing, functionally closed. This is what the intelligence actually shows. Operation Epic Fury began at 1:15 Eastern Time on February 28, 2026. United States and Israeli forces initiated coordinated strikes against Iranian military facilities, nuclear sites, and leadership targets. Supreme Leader Ali Khamenei was killed. Iran's Islamic Revolutionary Guard Corps, the IRGC, responded immediately. Retaliatory missile and drone strikes were launched across the Gulf region, targeting U.S. military bases, Israeli territory, and the energy infrastructure of Gulf states. The maritime consequences were immediate and cascading. According to Windward AI's daily maritime intelligence briefing, only 7 vessels crossed the Strait of Hormuz on March 2nd, a 61% decline from the prior day, and dramatically below the 7-day moving average of 79 crossings. By March 3rd, that figure had fallen to 4 crossings. On March 3rd, the Joint Maritime Information Center confirmed 0 tanker crossings. The IRGC formally declared the Strait of Hormuz closed on March 2nd. They warned that any vessel attempting transit would be targeted. That declaration was disputed by U.S. Central Command, but the market did not wait for legal clarification. By March 2nd, the world's leading P&I clubs, mutual insurers covering approximately 90% of the global merchant fleet, began issuing 72-hour notices canceling war risk extensions for vessels trading in the Middle East. Norway's Guard and Skuld, Britain's North Standard, the London P&I Club, and New York's American Club all suspended coverage. Without war risk insurance, no commercial operator will move a vessel. On March 2nd, Iran struck QatarEnergy's facilities at Ras Laffan Industrial City and Mesaieed Industrial City. QatarEnergy, operator of the world's largest LNG export complex, responsible for approximately 20% of global LNG supply, halted all production. European benchmark gas futures surged by as much as 54%. Dutch TTF prices rose 50%, the largest single-day move since the 2022 European energy crisis. Saudi Arabia's Ras Tanura refinery, with a processing capacity of 550,000 barrels per day, one of the largest in the world, was struck by Iranian drones and temporarily shut down as a precautionary measure. To understand why this matters, you need to go back to 1984. In March 1984, the tanker war, the naval phase of the Iran-Iraq War, entered its critical second phase. Iraq began sustained attacks on tankers serving Iranian ports, using French super-étendard aircraft, armed with Exocet missiles. Iran retaliated, targeting tankers serving Gulf states supporting Iraq. 71 merchant ships were attacked in 1984 alone, compared with 48 in the preceding 3 years combined. What followed became a defining test of whether a hostile power could use the strait as a weapon against the global economy. The answer in the 1980s was partially, temporarily, and at significant cost to all parties. According to documented historical records, more than 500 vessels were damaged or destroyed across the full duration of the tanker war from 1981 to 1988. Crucially, and this is the critical historical distinction, In the 1984 to 1988 tanker war, Iran did not close the strait. Despite repeated threats, Iran kept the corridor open because it depended on the same sea lanes for its own oil exports. The economic logic of mutual dependence preserved access. The 2026 situation is structurally different on two counts. First, Iran's domestic oil export infrastructure has already been severely degraded by U.S. and Israeli strikes. According to Windward AI, Iranian visible crude exports have effectively disappeared from transparent tracking systems as of March 2nd. Iran no longer needs the strait open for its own trade. The economic deterrent that kept Hormuz functional in the 1980s no longer applies. Second, and this is the technological inflection point, Iran achieved the functional closure of the world's most critical energy corridor, not with a naval fleet, not with manned aircraft armed with Exocet missiles, but with low-cost drone strikes and the credible threat of further attacks. The insurance market did the rest. In 1984, closing Hormuz required a navy. In 2026, it required drones and 72 hours. Three parties now control the trajectory of this crisis. Each has documented objectives, verified capabilities, and a clear vulnerability. The United States initiated Operation Epic Fury on February 28th. The stated strategic objective was the destruction of Iran's nuclear program and military command structure, including leadership targets. Khamenei's death was the highest profile result. President Trump posted on Truth Social, pledging to mobilize the U.S. International Development Finance Corporation to provide political risk insurance and financial guarantees for maritime trade, and stated that U.S. Navy escorts of tankers through the Strait of Hormuz were under active consideration. The post confirmed, "No matter what, the United States will guarantee the free flow of energy to the world." The United States' greatest documented vulnerability in this scenario is political economy. Trump himself acknowledged the domestic exposure, moving to contain energy price rises within days of the conflict beginning. The VLCC rate surged to $423,736 per day, translates directly to higher fuel prices for American consumers. The administration's willingness to absorb extended conflict is constrained by that domestic pressure. Iran's immediate strategic objective is retaliation at a scale that demonstrates continued deterrent capability following the loss of its supreme leader and significant military infrastructure. Iran's documented capability in this maritime domain is asymmetric and proven. According to Windward AI data, over 1,100 vessels experienced GPS and AIS interference within the first 24 hours of escalation. Windward identified at least 35 electronic jamming clusters across the Gulf region. More than 10 confirmed GNSS interference incidents were logged after February 27th, according to Capillary Intelligence. 4 tankers were confirmed struck in the opening phase of the conflict, per UKMTO documentation. MKD Vyom, with 1 crew fatality. Skylight, with 4 crew injured. Hercules Star off the UAE coast, and a container vessel drifting 3.5 nautical miles north of Ras Musandam after a portside engine room strike. Iran's greatest vulnerability is the condition of its own production and export infrastructure, following Operation Epic Fury. With visible exports collapsed, and Bandar Abbas, Iran's principal naval port, reporting active fires as of March 2nd per Windward AI, Iran's capacity to sustain extended maritime operations is under pressure. The third strategic actor in this crisis is not a government. It is the market itself, and it moved faster than any military force. Brent crude surged as much as 13% intraday to above $82 per barrel following the QatarEnergy shutdown, the highest level since January 2025. According to Poten and Partners broker data, the daily hire for a VLCC on the Arabian Gulf to Far East voyage reached $445,200 per day in assessed rates. The 2025 full-year VLCC average was $133,000 per day. According to Capeler, the strait handles 16 to 18 million barrels of crude per day. According to the EIA, approximately 20% of global seaborne LNG transits the same corridor, the majority from Qatar. Goldman Sachs analysis, cited by Bloomberg and Captain, assessed that if shipping through the Strait of Hormuz were halted for 1 month, European gas prices could more than double. Iraq announced forced production cuts of 1.5 million barrels per day after Hormuz storage facilities saturated, with warnings that cuts could expand to more than 3 million barrels per day if the situation persists, per Reuters. The Flashpoint Moment is not Operation Epic Fury. Operation Epic Fury was the trigger. The Flashpoint Moment is the insurance withdrawal of March 2, 2026. On March 2nd, the world's P&I clubs issued 72-hour cancellation notices on war risk coverage for vessels operating in the Middle East. This single administrative action, not a military strike, not an Iranian declaration, transformed a conflict into a functional economic blockade. The Capeler intelligence briefing of March 5th describes the closure as functioning as commercial deterrence rather than outright military blockade. No confirmed sea mines have been deployed. The strait has not been physically sealed. But the result is operationally identical. 280 dry bulk carriers trapped, 72 VLCCs, approximately 8% of global VLCC supply, immobilized in the Middle East Gulf per broker AeroData. 329 crude and product tankers caught in the operational freeze. Salalah recorded 57 delayed shipments. Jebel Ali and Khalifa ports, showing rising congestion indicators. As of March 5th, per Windward AI's one-week intelligence assessment, a tug operating approximately 18 nautical miles northeast of Kasab, Oman was struck by 2 missiles while attempting to tow an abandoned vessel, confirming that the threat envelope extends to salvage and auxiliary operations, not only commercial transit. Current status, as of this recording: the Strait of Hormuz has recorded 5 or fewer vessel crossings per day since March 2nd. The 7-day moving average has collapsed to 27 crossings against a baseline of approximately 77 to 79. The corridor is functionally closed. 3 scenarios are now on the table. Scenario 1: de-escalation. Analytical probability, 20 to 30%. Gulf states, Bahrain, UAE, Qatar, Kuwait, Saudi Arabia, issued a joint statement on March 1st condemning Iranian attacks, but simultaneously signaling their desire for a ceasefire. Trump's insurance guarantee and tanker escort pledge represent a diplomatic off-ramp as much as a military commitment. If back-channel negotiations initiated through Gulf intermediaries produce a ceasefire framework within 10 to 14 days, commercial insurance cover could be reinstated, and vessel traffic could resume. Gas futures are already slightly easing from peak levels as of March 3rd, per market data, suggesting traders are partially pricing this scenario. The constraint: no verified ceasefire talks have been publicly confirmed as of this recording date. Scenario 2: controlled escalation. Analytical probability, 45 to 55%. The most likely trajectory based on current, verified data. U.S. Navy escorts begin limited tanker convoys, echoing Operation Earnest Will of 1987, when the United States reflagged Kuwaiti tankers and provided naval escorts through the Gulf. Shipping partially resumes at elevated risk premiums. VLCC rates stabilize in the $300,000 to $400,000 per day range. QatarEnergy restarts partial LNG production within weeks. The conflict persists at lower intensity, with periodic strikes and counterstrikes, but without a defined end state. This is the scenario Goldman Sachs analysis implicitly prices in its gas doubling estimate tied to a 30-day disruption. Scenario 3: full escalation. Analytical probability, 20 to 30%. Iran strikes a U.S. Navy vessel or kills a significant number of U.S. personnel in a single incident. U.S. domestic political pressure forces expanded military operations. Iraq production cuts exceed 3 million barrels per day, as warned by the Iraqi government official cited by Reuters. QatarEnergy's shutdown extends beyond 30 days. Goldman Sachs's 130% Asian LNG spot price increase scenario materializes. VLCC rates approach the $700,000 to $800,000 per day range cited as possible by market participants in the March 2026 reporting period. Structural rerouting around the Cape of Good Hope becomes the new baseline for global energy shipping, adding weeks to transit times and permanently repricing the cost of moving energy. The verified intelligence points to 4 variables that will determine the outcome of this crisis. None of them are military. All of them are economic or logistical. Critical variable 1. War risk insurance reinstatement. Current status. As of March 5, 2026, the world's major P&I clubs have canceled war risk extensions for Middle East operations. No reinstatement timeline has been confirmed by any major insurer. Why it is decisive. Without war risk cover, no commercial operator will transit the strait regardless of military escort. The insurance market, not the IRGC, not the U.S. Navy, is the functional gatekeeper of Hormuz. Reinstatement requires insurer confidence in safe passage. That confidence requires either a verified ceasefire or sustained naval presence that demonstrably reduces vessel strike risk. Neither condition currently exists. Critical variable 2. QatarEnergy restart timeline. Current status. QatarEnergy's Ras Laffan facility, covering approximately 20% of global LNG supply, remains shut as of this recording. No confirmed restart date has been issued. Why it is decisive. Goldman Sachs analysis projects European gas prices could more than double if the shutdown extends 1 month. European gas storage inventories are described by Bruegel analyst Simone Tagliapietra as unusually low heading into the refill season. The restart is constrained not only by security conditions, but by the physical process of safely restarting a complex LNG facility following a precautionary shutdown. Critical variable 3. Iraq production cut expansion. Current status. Iraq announced forced cuts of 1.5 million barrels per day, with official warnings of expansion to over 3 million barrels per day if Hormuz transit remains blocked. Iraq's January production was documented at approximately 4 million barrels per day. Why it is decisive. Iraq is a non-belligerent, whose oil infrastructure is being strangled by geography. If cuts expand to 3 million barrels per day, the global oil market, already absorbing the loss of Gulf LNG and reduced VLCC capacity, faces a simultaneous crude supply shock that Brent crude at $82 per barrel does not yet fully price. Critical variable 4. Cape of Good Hope diversion permanence. Current status. Diversion traffic around the Cape of Good Hope surged 112% within 24 hours of the initial strikes, per Windward AI. The diversion pattern has remained elevated through March 5th. Why it is decisive. Cape diversion adds approximately 2 weeks to the Middle East to Europe voyage. In a prolonged disruption, this structural rerouting does not simply delay energy supply. It physically reduces the number of available tankers in the market by extending their voyage time. Capeeler analysis confirms this creates a fundamental supply squeeze on available LNG carrier capacity even before accounting for direct vessel losses. The Strait of Hormuz has been threatened many times. It has never been closed like this. In 1984, it took a war between 2 nations and 7 years to damage 500 ships. In 2026, it took 72 hours and an insurance withdrawal to stop 329. The next briefing covers the scenario that market participants are not yet fully pricing. Iraq's January oil production was documented at approximately 4 million barrels per day. Its government has warned of cuts exceeding 3 million barrels per day if Hormuz remains blocked. Iraq is not a party to this war. It has no exit. At the same time, Japan has already asked its government to release strategic oil reserves. Japanese refiners source approximately 70% of their Middle Eastern crude through tankers that pass through the Strait of Hormuz. Korea's Hyundai Glovis is preparing contingency plans. The Asian demand shock has not yet arrived in the data. When it does, that is a separate briefing entirely. The world is always one decision away.